Hello, and if you own or have thought about owning any bond fund, that's very likely for at least one of two reasons: safety and diversification. Let's take a look at a $40 billion bond fund, the VCSH, and we'll see the headline 30-day SEC yield is 5.17% with an average maturity of 2.8 years. The yield to maturity is 5.3%, but we'll ignore that since over 90% of bonds are callable, so they're supposed to show the yield to worst, which is definitely lower. Regardless, you can go to the Treasury Direct website today, sign up for the next 30-day government bill auction, and earn 5.37% risk-free and commission-free with as little as $100. You eliminate all your market risk, all your credit risk, and earn more on your money for just a month. To find out what kind of credit risk is in the VCSH, we'll check their top 10 corporate holdings and see that 3 of them are the same credit. That's not diversification. We also see the 6th unique credit, Charter Communications Operating LLC, is non-investment grade. That's not safety. Now, let's look in the GoodFill app, available in the Apple App Store. Set our maximum maturity to 5 years, credit risk to medium. No non-investment grade issuers. In the business development company space, New Mountain and Barings have slightly toppy leverage at 13 and 11 times, but were solidly profitable last quarter and last year. Free cash in the quarter was $125 million and $139 million respectively. Tangible book value was $1.3 billion and $1.2 billion, with market caps of $1.2 billion and $960 million. They look fine. Piedmont Operating Partnership and EPR, both in the property business, leveraged 6.5 and 5.7 times respectively. Not terrible. Free cash flow was small but positive last quarter as well as last year. Tangible book value was $1.4 and $2.4 billion, with market caps of $770 million and $3.1 billion. We'll call them both keepers. Concentrix and Targa, very reasonable leverage at 5 and 3.3 times. Annual net income of $300 million and $1.5 billion. Free cash of $500 and $820 million, with market caps of $4 and $24 billion. All good. Now we are searching for value, but let's take a quick look at a couple of medium risk names we passed over: Prospect and Paramount. Prospect barely has any top-line revenue. Neither one has any EBITDA or net income, so their leverage is off the charts, while Paramount has negative $15 billion in tangible book value. That's just too many red flags. Now, let's move up in quality and set our credit risk to low. Oryx of Japan has some business similarity to AerCap of Ireland, the 5th name in the VCSH top 5. Oryx has slightly higher leverage, about double the tangible book value, and positive free cash flow versus $1 billion negative for AerCap. Brookfield and Renaissance Re both had solidly positive free cash flow, $2 and $3.5 billion in net income last year, and $14 billion in tangible book value. MUFG Financial Group, also of Japan. Let's see how it stacks up against B of A, the issuer of 3 out of the top 10 VCSH bonds. B of A had 25% more tangible book value and double MUFG's net income, while MUFG had double B of A's free cash flow. No wonder Warren Buffett went big in Japan. Southern California Edison is a regulated utility, and this is a secured bond, meaning it's collateralized, which gets it the low-risk agency rating. Parent company Edison International has leverage above 6 times, near the high end of conservative, and negative free cash flow due to large capital investments. Net income was positive in the latest quarter and full year. Tangible book value is $18 billion, and stock market capitalization is over $26 billion. Harman is our last low-risk name. Let's see how parent company Samsung compares to another low-risk credit, Intel. Samsung has 5 times the tangible book value, 1/10 the leverage, and 10 times the net income of Intel. I think we're good with Samsung and Harman. Now let's take a look at our portfolio holistically. We have just one bank holding company out of 12 names, compared with 5 out of the top 10 for VCSH, one leasing company, one insurance company, 2 BDCs, one asset manager, 2 real estate companies, 1 energy, 1 utility, and 2 technology firms. Half our bonds are low risk, and even with no non-investment grade issues, we earn over 6.5%, 1.3% higher than the VCSH. That's an extra $1,000 on a $30,000 portfolio. The average survival probability, the market expectation that a bond will suffer no impairment, is 90%, and VCSH doesn't disclose this figure, but I would be shocked if it isn't lower. Rating agencies will be the first to tell you that the overwhelming majority of the 1 in 1,000 bond defaulters every year, ticking up to 5 in 1,000 in the financial crisis and COVID years, were non-investment grade companies. This has been the case going way back before 2010, when Dodd-Frank imposed severe personal penalties on executives who materially misrepresent their financial condition. But there was one glaring exception in those 14 years, and that was Silicon Valley Bank. That was a bolt out of a clear blue sky, an issuer who spent just 2 days as non-investment grade before defaulting. How do you protect yourself from that? To get an idea of what we're up against, let's see where the $2.5 billion of Silicon Valley Bank bonds are trading today. As it turns out, all 5 senior unsecured issues have traded an average of 1 to 3 times a day for the past 2 months, and are all priced between 61 and 64 cents on the dollar, less than a 40% principal loss for investors. If one of our medium risk bonds, say EPR, gets hit by a bus 3 months after we buy it and loses 40% of its value, the whole portfolio still yields 4.7%, just 0.5% below the VCSH. But don't take my word for it. Open the GoodFill app, email the portfolio to yourself, and apply any stress scenario you like. Once you're happy with it, enter your Interactive Broker's account number if you have one, upload it with Basket Trader, and you'll be able to select all or nothing if you don't want any partial fills. Interactive charges 0.1% upfront commission on any size, which is the lowest in the market. Sometimes downstream platforms add on a bit more, and the prices you export from GoodFill have 0.2% built in. You should never pay more than that in total to buy any bond. You can send each order individually or all together, and you'll find out as soon as each one is done. If you have any tax credits that offset ordinary income from a business, for instance, Those can reduce your taxable bond income. And if you're one of 40 million Americans with an IRA, buy your corporate bonds in there and they'll be tax-free. If your objective is to save your money, it's not hard to decisively beat bond funds, reducing your risk and increasing your income. If you're in a bond fund now and have any doubt about individual bonds, or you have any cash in a bank that you won't use for a couple of months, go to Treasury Direct, put it all in the next bill auction while you decide what's best for you. Get to know corporate bonds. Follow the live price action on your lunch break or a walk through Central Park. And you'll be sure to find your next GoodFill.